What are the tax implications of a generation-skipping trust? Have you ever wondered how a generation-skipping trust can impact your retirement estate planning? This topic is essential for anyone looking to secure their family's financial future. A generation-skipping trust is an estate planning tool that allows individuals to transfer assets directly to beneficiaries who are at least 2 generations younger. This often means passing wealth to grandchildren or great-grandchildren while bypassing the intermediate generation. One of the main reasons people use this strategy is to avoid double taxation. Typically, when assets are passed down through generations, they are taxed at each level. By skipping a generation, you can help prevent those assets from being taxed twice. But what are the tax implications of this approach? First, there is a federal tax known as the Generation Skipping Transfer Tax. This tax applies to transfers made to skip persons, like grandchildren, if the transfer exceeds a specific exemption limit. As of 2024, the exemption is set at $13,600,000 per person. If your transfer is below this amount, it will not be subject to the generation skipping transfer tax. However, if it exceeds this threshold, the tax rate can range from 18% to 40%, which is the same as the estate tax rate. Another important aspect to consider is how the income generated by the trust is taxed. While a generation-skipping trust can help avoid estate taxes, the income produced by the trust itself may still be subject to taxation. This income is usually taxed at the trust level, which can be higher than individual tax rates. In the context of retirement planning, a generation-skipping trust offers several benefits. For one, it provides asset protection. By transferring assets into a trust, you can safeguard them from creditors and ensure they are preserved for future generations. Additionally, this strategy can help minimize taxes by avoiding the double taxation that typically occurs when assets pass through multiple generations. When designating a generation-skipping trust as a beneficiary, it is crucial to structure the trust correctly to maximize tax benefits and align with your overall retirement goals. This means working with a knowledgeable estate planning professional to ensure everything is set up properly. Incorporating a generation-skipping trust into your retirement planning can be especially useful for individuals with significant assets. It allows for a strategic transfer of wealth to younger generations while maintaining control over how those assets are distributed. As you think about your long-term financial strategy, remember that a generation-skipping trust should be part of a broader plan that considers both tax implications and family goals. Understanding the generation-skipping transfer tax and how it applies to your situation is essential for effective retirement estate planning.